Hey there, welcome back to our channel. Ever wondered how the repo rate shapes our economy? It's a fascinating topic that impacts everything from your mortgage rates to the overall health of the economy. Let's break it down in simple terms. The repo rate, or repurchase rate, is the interest rate at which a country's central bank lends money to commercial banks for the short term, usually in exchange for government securities. This is a crucial mechanism in the financial system. Think of it as a lever that central banks use to manage the economy. By adjusting this rate, they can influence the amount of money circulating in the economy. First off, let's talk about what happens when the central bank raises the repo rate. When the central bank raises the repo rate, borrowing becomes more expensive for banks. This means that banks will, in turn, raise the interest rates they charge their customers. This typically leads to higher interest rates for consumers and businesses. Higher interest rates can affect everything from personal loans to business financing. As borrowing costs rise, spending and demand decrease, which helps to control inflation. When people and businesses spend less, prices tend to stabilize or even drop. On the flip side, lowering the repo rate makes borrowing cheaper. This can have a stimulating effect on the economy. This encourages spending and investment, stimulating economic growth but potentially boosting inflation. More money in the economy can lead to higher prices if not managed carefully. Next, we have the role of the repo rate in managing liquidity. The repo rate is crucial for managing liquidity in the banking system. Liquidity refers to how easily assets can be converted into cash. A higher repo rate drains liquidity from the market because borrowing becomes more expensive for commercial banks. This can lead to tighter financial conditions. Conversely, a lower repo rate injects liquidity, making it easier for banks to borrow and lend money. This can help to keep the economy moving smoothly. Third, the repo rate has a significant impact on the signaling to commercial banks. When the central bank adjusts the repo rate, it's signaling to commercial banks how they should set their lending and deposit rates. This is a key part of monetary policy. If the repo rate goes up, banks raise their interest rates on loans and deposits, tightening monetary conditions. This can slow down borrowing and spending. Lowering the repo rate has the opposite effect, promoting lower lending rates, which can stimulate economic activity. This can be particularly useful during economic downturns. Finally, the repo rate is essential for ensuring financial stability. During times of economic stress, a lower repo rate provides banks with cheaper access to funds, ensuring they can continue operations and avoid liquidity crises. This can prevent financial panic and maintain confidence in the banking system. So to sum it up, the repo rate is a powerful tool that central banks use to balance economic growth, control inflation, and maintain financial stability. It's a delicate balancing act that requires careful consideration and timing. If you found this video helpful, make sure to hit that like button and subscribe for more insights into the fascinating world of economics. Thanks for watching, and see you next time. Stay curious and keep learning. Thanks for watching, and see you next time.